Hey everyone, it's Sam, and let's talk about something that affects us all, the Consumer Price Index or CPI. You know that thing that tells us how much more expensive stuff is getting? Yeah, that's CPI, and it's a really big deal, especially if you're into investing or just want to understand what's going on with your money. See, CPI isn't just some boring economic number, it's a measure of inflation. And inflation is like this invisible force that can either erode your wealth or, if you play it right, it can actually help you build it. CPI directly impacts interest rates, how much your dollar is actually worth, and even how investors feel about the future. So, whether you're into stocks, real estate, gold, crypto, or just trying to make smart financial decisions, understanding CPI and its ripple effects is absolutely crucial. In this video, we're going to break down exactly how CPI impacts different asset classes, so you can make more informed decisions and potentially come out ahead. Let's start with gold, the OG inflation hedge. You see, gold has this intrinsic value that's kind of stood the test of time. It's tangible, it's finite, and for centuries it's been seen as a safe haven asset. When inflation runs hot, and that purchasing power of your dollar starts to dwindle, people get scared. They look for something reliable to park their money in, something that historically holds its value, and that's where gold comes in. Think about it. When CPI is high and a loaf of bread suddenly costs twice as much, that erodes the value of your cash. But gold tends to hold its ground or even go up in price as investors pile in seeking shelter from the inflationary storm. Remember back in 2020 to 2022 when inflation was going crazy? Gold prices surged past $2,000 an ounce. Why? Because investors were scared and they flocked to gold as a safe haven. This is a classic example of how CPI can directly impact asset prices. So, if you're looking for an asset that tends to do well when inflation rears its ugly head, gold might be something to consider. Now let's talk stocks, because CPI can make the stock market feel like a roller coaster. See, when CPI goes up, the Federal Reserve often steps in to try and cool things down. And how do they do that? Interest rate hikes. They raise interest rates to make borrowing more expensive, hoping to slow down the economy and get inflation under control. But here's the thing, not all stocks react to interest rate hikes the same way. Growth stocks, like those tech companies that are all about rapid expansion, they tend to get hit harder when rates rise. Their future earnings become less valuable in a higher rate environment. On the other hand, value stocks, companies that are more established and often pay dividends, they can sometimes weather the storm a bit better. And then you have cyclical stocks, companies tied to the economic cycle. Those can actually benefit from rising inflation and interest rates, at least in the short term. So, when you're looking at stocks in a high CPI environment, it's crucial to understand which sectors are likely to benefit and which ones are most at risk. Now let's zoom out and look at the bigger picture with market indices like the S&P 500 or the Dow Jones Industrial Average. You see, these indices are like the pulse of the overall stock market. They reflect the sentiment of investors, and CPI plays a big role in shaping that sentiment. When CPI comes in hot, higher than expected, it can trigger fear in the markets. Investors get worried about those aggressive rate hikes we talked about, and they start selling off stocks, driving those indices down. We saw this happen a lot in 2022. Every time a CPI report came out hotter than expected, the market would tank. On the flip side, when CPI cools down, and inflation seems to be under control, it can spark rallies in the markets. Investors breathe a sigh of relief, they become more optimistic about the future, and they start buying up stocks again, pushing those indices higher. So, keeping an eye on CPI releases and how the markets react can give you valuable insights into overall market sentiment. Okay, now let's take this global and talk about currencies, because CPI can make waves in the foreign exchange market too. See, when a country's CPI is rising, it usually means their central bank is more likely to raise interest rates, and higher interest rates tend to attract foreign investment. Think about it, if you can get a higher return on your money by investing in a country with rising interest rates, you're more likely to move your money there, right? This increased demand for that country's currency can cause it to strengthen relative to other currencies. On the other hand, if a country's CPI is low and their interest rates are stagnant, investors might start looking elsewhere for better returns. This can lead to a decrease in demand for their currency, causing it to weaken. So, if you're trading currencies, understanding the CPI and interest rate dynamics of different countries is super important. Now let's talk bonds. Bonds are like the more stable, less volatile cousin of stocks, but they're definitely not immune to the effects of CPI. See, bonds are basically loans that you give to governments or corporations, and they pay you a fixed interest rate over a certain period. But here's the thing. Inflation eats away at the value of those fixed interest payments. When CPI is high and inflation is rising, the purchasing power of those future interest payments decreases. This makes existing bonds less attractive to investors and they might start selling them off. This selling pressure can lead to a drop in bond prices and a spike in bond yields. And here's something else to keep in mind. Long-term bonds are generally more sensitive to inflation than short-term bonds. Why? Because inflation has more time to erode the value of those future interest payments. So, in a rising CPI environment, you might see investors shifting towards shorter-term bonds or inflation-protected securities like TIPS, which are designed to adjust their principal value with inflation. And finally, let's talk about crypto. Cryptocurrencies like Bitcoin are relatively new to the game, so their relationship with CPI is still evolving. On the one hand, high CPI and the resulting economic uncertainty can create a risk-off environment where investors flee to the perceived safety of traditional assets, potentially hurting crypto prices. But here's where it gets interesting. Crypto enthusiasts often argue that Bitcoin and other cryptocurrencies can act as a hedge against inflation, kind of like digital gold. They point to Bitcoin's limited supply and decentralized nature as characteristics that could protect it from inflationary pressures. And we have seen this narrative-driven buying during periods of high inflation, where investors flock to Bitcoin as an alternative to fiat currencies. However, it's important to remember that crypto is still a very volatile asset class, and its long-term relationship with CPI is still uncertain. So, there you have it. We've covered how CPI, that seemingly simple measure of inflation, can have a ripple effect across the entire investing landscape. From gold to stocks, bonds to currencies, and even the exciting world of crypto, CPI is a key macro trigger that shapes central bank policy, influences asset flows, and ultimately impacts your investment decisions. Knowing how to interpret CPI data and anticipate its potential effects on different asset classes can give you a serious edge in today's markets. It's like having a secret weapon that helps you navigate the ups and downs of the financial world. So, stay informed, stay ahead of the curve, and most importantly, make sure you're subscribed to this channel for more insights on how to make smarter financial decisions. We'll keep you updated on all things CPI and more.